Good afternoon, ladies and gentlemen, and welcome to the inaugural Unlock the Stock event. Our host will be the finance ghost and Mark Tobin from Coffee Microcaps, and they will be facilitating the breakout rooms at the end of the presentation session of this event. We would like to welcome our first two companies, Afrimat, represented by Andries van Heerden, CEO, and Pieter de Wit, CFO, and REIT, represented by Quintin Rossi, CEO, and Christiaan Barnard, CFO. Before we commence, a couple of housekeeping rules. Each company will do a presentation of 12 minutes each. Thereafter, you will see a button on the bottom of your screen where you can select which breakout room you would like to join to ask questions to the management teams. The Q&A session will be 20 minutes in duration. You are more than welcome to leave the one room and join the other room by making a selection by using the breakaway room function. Please note that you will only be allowed to post your questions by typing them into the chat function at the bottom of your screen. Please also note that this event is being recorded. Once in the breakout room, you will see an email address if you would like to be added to that company's distribution list. I now hand you over to Andries van Heerden.
Good afternoon, everybody, and thank you for the opportunity. I just want to share the screen quickly and make sure that you let's see what's going on here. Go. Right. Can you just confirm that you can see the screen on the other side?
Yes, Andries, we can see it.
Right, thank you. Right, so Afrimat is a mid-tier mining company. We started off as a material supplier in the construction materials space, and we grew into the mid-tier mining space. So at the moment, we do business in three major segments. Our construction materials business, consisting of aggregates and ready-mix concrete blocks and that sort of thing. Then our industrial minerals business, which is a limestone and dolomite business. And our bulk commodities business is a business that we added a few years ago, which has now become quite a significant part of our business, where we do iron ore, anthracite, and we've also recently added some more minerals such as manganese and phosphate, which we will start mining in the future. On the graph there, you'll see that our revenue from the different business units, the bulk commodities being the biggest, about 49%, and our operating profit dominated from that, but construction materials being the second largest, and then industrial minerals. We operate throughout the entire country. We have an operation in each province of South Africa. We've just recently added a business in the northwest to complete the entire country. And on the screen there, you can see all the different businesses that we do operate in. So, what sets Afrimat apart? Firstly, we believe our company culture. Anybody can start a mine, and anybody can buy the equipment that is necessary, but it really takes people and a special kind of person to make a business work, especially in the South African context. On top of that, our strategy, where we have over the years, we've developed a strategy of diversification. We started off in construction materials, we went into industrial minerals, then went into commodities, and we grew the business to have quite a wide spread and to have different cycles that we are exposed to, and it's been working very, very well for us. The third leg that sets this business apart is our financial discipline. The company has, over the years, done quite well with our return on the investments that we've done, something that we are quite proud of is that our compound average growth rate in after-tax profit since the 2008 crisis, and February 2009 was the year we reported on that year. Since then, our compound average growth rate has been 22.5% over more than a decade, which we are very satisfied with. And on top of that, we have a very, very strong balance sheet, very, very good returns on our investments. Our return on net assets is significantly above 30% at the moment. We also make sure that the assets that we invest in are assets that we derive a proper competitive advantage from, either through the geographic location, the unique metallurgy, making sure that we have a superior quality product, or we have a structural cost advantage from that. So all of this, together with a culture which is based on 9 legs that our culture is really built on in terms of relationships, teamwork, empowering of our people, having the right winning attitude, but in an environment where we really truly care for our people, and having a culture that's driven on results, strong people, making sure that we develop the right skills and the right entrepreneurial drive. But all of this in an environment where people remain humble and remain within a value system that we are very proud of. So this whole combination is really what makes Afrimat different, and we sum that up with a term that we use: excellence with integrity. So just quickly, construction materials consists of aggregates, bricks and blocks, and ready-mix concrete. It is a difficult environment to operate in at the moment. We are seeing a little bit of work coming in the road space, and some of the renewable projects that are coming is quite promising. But we have come through a difficult time, and the value of our strategy to diversify is really shown. If we stayed in this business 10 years ago, we would have had a very mediocre growth rate, but we could accelerate our growth rate and build on our strengths that came from this part of the business. Industrial minerals, this is a relatively small part of our business, but a really, really nice niche business. It's a very stable business, almost an annuity income business, good margins. We have just recently acquired a fourth limestone mine in the Northwest Province. As I said just now, we are waiting for Competition Commission approval to incorporate that. It's relatively small, but once again, very good return on investment is expected from that. Very nice little business, very stable. Then bulk commodities. We started with Demaneng mine about 5 years ago. Turned out to be a fantastic investment that we did then. We subsequently bought the Khoza mines, which was a group of mining rights. We brought Jenkins mine to the market. We actually got that mine up and running in a record time. Producing from there, we have a takeoff agreement for iron ore from that mine to ArcelorMittal. Once again, this mine is doing exceptionally well. We also acquired Nkomati anthracite mine almost 2 years ago. That was quite a serious turnaround. By the way, Afrimat has a track record of turnarounds. Even Demaneng was a turnaround. We bought that out of business rescue. Nkomati was in business rescue. We've taken them out, turned them around. Nkomati is now profitable for probably 6-7 months in a row now. We are very, very satisfied with that business as well. Not an easy business, but we turned it around, and it is doing very, very well. We've also recently announced further acquisitions. Grabbenhaven is a manganese mine in the Northern Cape. We are in the process of doing the detailed planning of how to start with that mine. We're waiting for a water use license and the Section 11 transfer approval before we can really commence that. That will probably happen in the second half of this calendar year, that we'll really start working on opening up that mine, and it'll take us about 12 months from the day we start until we start selling the first product from there. Glenover, very, very exciting new project that we announced towards the end of last year, brings us into modern minerals. So we are, from there, we'll be supplying, we are already supplying phosphate. We'll also enter the rare earths market from there. There are rare earths in that deposit. And then also vermiculite will be a third mineral out of that deposit, relatively small business. But the real excitement is around the phosphates and the rare earths out of that business. And it's also a project that we do in 2 phases, where the initial phase, we just bought dumps that were well defined on the site. That is actually just stock that we bought, so we didn't need competition commission and all the other approvals that you normally need, because it's just stock that we bought. And now the next phases will be to buy the mine outright, which we will probably do later. Financially, the business is doing very, very well. Our operating margin, the last time we spoke to the market, was 24%. Our headline earnings per share, as I said, we had a compound average growth rate over the last 12 years of 22.5%. We've been a very consistent dividend payer. And the net cash from operating activities has also been very, very good, giving us a very strong balance sheet and the ability to grow the business. A return on net operating assets at about 34%. On the graph there, you can see what the acquisitions have done for us over the years. The green line at the bottom is what we would have had if we only stayed with construction materials. The red line is what we reported, and the difference is the value created by the strategy that we embarked on. So I suppose, lastly, what is a good reason for you to invest in Afrimat? So obviously, I'm very blessed with the team that I am part of. The team that we have is a very strong management team. We have a very good track record for capital allocation. The business is highly cash generative with a lot of free cash. We have good operational diversification. There's a good moat around most of our assets. All of our assets have a good moat around them, and the business is scalable, which reduces our exposure to market cycles. So really what I'm trying to say, the business is in a healthy financial position. We have been consistently delivering value for about 15 years since we listed. And we have a resilient entrepreneurial culture and people that are really passionate and driven to give their results. So yeah, that's Afrimat, the business that we are very passionate about and very excited about. Thank you very much.
Thank you, Andries. I now hand over to Quintin Rossi, CEO of Spear REIT.
Thank you very much, Marlies. Morning or afternoon, everyone. Thank you for taking the time to join for us to share a bit about the Spear story and why our business is such a strong value proposition. Bit of our backstory. So Spear was founded in 2011 by industry veterans Mike Flax, Abu Barachia, and myself. The business was founded on the premise that we wanted to establish a Western Cape focused real estate investment vehicle. And one thing that we felt was very important for us was to be focused on a region where we would be close to our assets. And that has basically translated into where the business is today. As the then founders and still very involved in the business today, we felt that the Western Cape, we had a very strong understanding of the Western Cape's property fundamentals and where we would see the opportunities. So as I said, we started out life in 2011 with a 72,000 square meter real estate portfolio valued at approximately 354 million rand. We had growth intentions for the business, and we utilized private capital to grow the business up to a point. In 2016, we had the privilege of listing Spear on the stock exchange as a REIT, and we then listed a 1.4 billion rand Western Cape focused portfolio. Now, Spear, as a specialist fund, obtains its specialization through the regional approach to only investing into the Western Cape, and our diversification is obtained through the investment across asset types, so commercial, industrial, retail, hospitality, and mixed use. So where are we today as a business? The Spear portfolio is valued at about 4.6 billion rand and spread across 470,000 square meters of gross lettable area. As a business, we've got a strong bias towards industrial warehousing, multi-let industrial, and convenience retail assets. Spear is a fully internally managed REIT, so we do everything ourselves internally, from financial management, asset management, property management, development management, etc. There's no external manco, so the real focus is to grow earnings as opposed to just to grow the asset base for a management fee. Our aspirations, we believe that we would have aspirations to grow to a meaningful mid-size REIT with an assets under ownership of about 15 billion rand with a market cap of 9 billion rand. The bottom of the slide is my incredible Exco team that I have the privilege of leading. Our CFO, Christiaan Barnard, our Chief Operations Officer, Cliff Tureen, and our Chief Investment Officer, Kim Pfaff Cog. It's a bit about our story, just starting life out in 2011, operating as a private investment company up until November 2016. Some milestone growth stories was from the listing in 2016, the 1.4 billion portfolio, more than doubling that portfolio through the acquisition of some rather major assets within the Western Cape. As you can see, in 2018, assets increasing to 3.13 billion under ownership. Followed by quite another large growth for the business in 2019-2020, pre-COVID, assets under ownership increasing to 4.18 billion. When COVID hit, we obviously took an internal focus and started looking at organic redevelopment and value creation opportunities within the portfolio through the redevelopment of existing industrial assets for purpose long-term leases with the likes of Nampak, Grindrod Logistics, and Mambo's Plastics, which then took us to 2020. We've announced on SENS the acquisition of a property in Parow, which will take our assets under ownership to 4.6 billion. Our mission statement is to be the leading Western Cape focused REIT and to grow our distribution per share ahead of inflation on an annualized basis, but also to operate within the top quartile of our peer group. And how do we do that? We do that through the execution of certain strategic objectives. And one of the things that we have been since inception are value investors. As a management team, we believe that the value that you create for your shareholders doesn't just happen on an exit. It actually also happens on when you acquire the property, at what value you acquire it, because that then allows you to really ingrain your asset management initiatives over the asset, which will allow for further capital growth and also strengthening of your net cash flows. We have also set out to remain an authentic and consistent distribution paying REIT. Right through COVID, right through the pandemic, we honored our commitment to our shareholders that we will remain as long as possible for when liquidity and solvency ratios were met, we would be paying out a distribution. And to many of our private clients, they have displayed incredible gratitude for the fact that we honored that obligation. Our strategy is also to follow more of a less is more approach. So you'll see that the portfolio of 32 properties, it's not a massive portfolio, but it's a portfolio made up of high quality, high value assets. We also believe that there is an opportunity to unlock shareholder value through the prudent recycling of assets into either larger or more long-dated income-producing assets. So that's our disposal strategy. And given the fact that we are such hands-on managers of our assets, since the inception of this business, our occupancy rate across the portfolio has never dipped below 92%. And that is as a result of the fact that our proximity to our assets is excellent. We know our tenants, we know our market, and also the rate per square meter across the portfolio isn't over-rented, thus resulting in tenants opting to stay within our portfolio, taking into account the cost of moving and the cost of other rental opportunities. And I think the other important thing for the business is that which aligns with our mission statement, is that we have maintained or exceeded every single one of our market guidance forecasts given to the market since 2016, which underpins management's credibility, which underpins the strength of the cash flows, as well as the resilient nature of the portfolio. So a couple of salient details. As I mentioned, the portfolio is made up of 32 100% Western Cape assets. The average property value is approximately 140.7 million per property. The in-force escalation, which is effectively the rate at which the rentals would increase on an average annually, is 6.44% across the 470,000 square meters of gross lettable area. Our occupancy rate, which, and just to bear in mind, this is at half year, so we haven't yet released our final results, which is just on 93% occupancy rate. And then another thing that was very prevalent during COVID was how much rental are we actually collecting? And we are incredibly proud with the fact that we have collected 97.3% of our rentals right through the pandemic 2020, right through 2021, and our cash collections have only strengthened during this time, and we are now very close to returning back to a pre-COVID cash collection scenario. Having a look at our published results for the half year, we exceeded the forecast of a 6% growth in our distribution per share, given the fact that our cash collections were very strong. We increased our payout ratio to 85% from our funds from operation. Our tangible net asset value per share had increased by 3% to R11.94, and our reported at half-year loan-to-value ratio was at 45%. However, in February of this year, we conducted an equity capital raise, and that loan-to-value ratio has now dropped to between 38 and 39% loan-to-value. Another factor for listeners to take into account, our CFO has done an exceptional job in refinancing quite a large portion of our debt portfolio, and we have seen a consistent decline of our cost of debt as a business over the last 6 years, as A, the quality of the portfolio has improved, and B, the credit rating of Spear as a borrower has improved with the various banks that we bank with. Just in terms of collections, they say that profit is vanity, but cash is reality. And I'm pleased to say that we've collected 96% of our retail tenants' rentals, 98% of our commercial tenants' rentals, 97% of our industrial tenants' rentals, and 98% of our hospitality tenants' rentals. And the only differential is a timing issue when we collect, because we collect some of our municipal charges are collected at a different date than the base rental from our tenants. Taking a quick look at the portfolio, I mentioned earlier that we do follow what we call a less is more approach. So we'll own fewer assets, but assets of higher value. So currently you'll see that our top 5 assets make up over 2 billion rand of our portfolio. It's also quite a beautiful picture of diversification. We have as our largest assets a 85,000 square meter multi-let industrial park with major brands like Consol, Tuffy, Glass Partners, Technical Systems, Mambo's Plastics, and Imperial as some of the key tenants within that asset. Then we have the Liberty Life Regional Head Office as another commercial asset in Century City. We have Sable Square Shopping Centre, which is a mixed-use asset, which will also see the addition in the not-too-distant future of about 125 to 200 residential apartments. And then Northgate Corporate Estate, situated on the N1, also a head office to many companies like Moore, Yo-Yo, and Vida E Cafe head office. Having a look at our portfolio split by value, revenue, and GLA, what's notable and what's been one of the moats around our business even during the COVID period was that 55% of our portfolio is industrial, and it's a mixture of small, medium, large industrial warehousing, modern logistics, as well as other industrial usages. Another factor to bear in mind is that we have started to exit hospitality, so that exposure of the percentiles reflected in hospitality is a lot lower than what it was reported at half year, and we'll report the updated numbers at our pre-close presentation, which will happen next week on Monday. But again, a very good diversified portfolio of 100% Western Cape assets. And then for us as a business, we don't just pay lip service to looking after the environment. We feel that it's our corporate responsibility to ensure that we place less and less reliance on fossil fuel generated electricity supply. We set out with a strategy as a management team to cover 50% or more of our portfolio in PV solar. We are making really good progress on that front. Currently, about 30% of the portfolio is covered in PV solar. By the end of the year, we should have 63% of the portfolio covered with PV solar. We have effectively saved over 2.8 million kilograms of carbon emissions and generated on the 28% now 1.85 million kilowatt hours of electricity supply, which is completely in line with our strategy. But also we've adopted a people, planet, profit approach. So we've monetized the roof space on our portfolio. We've used that for profit, but also we've used it to strengthen the social contract that we believe we have with ourselves and the general population, which I'll touch on in a few minutes. Just what is our outlook as a business? Our portfolio is of a high quality, underpinned by strong tenancies, strong lease covenants, and is located in South Africa's best location for growth. The Western Cape real estate fundamentals have historically always outperformed the rest of South Africa, and the real estate market is buoyant and has even shown that it's leading the recovery of this post-pandemic environment. The semigration to the Western Cape is evident in demand across the real estate sector, from residential to industrial to retail and commercial. As a business, we remain 100% committed to South Africa and to the Western Cape. We have no interest in investing anywhere outside of the Western Cape, given the fact that, in Afrikaans is a saying that ver van jou goed, naby aan jou skade, which means that the further away you are from your assets, the possibility of your assets being damaged is a lot closer. And for us, we're a business that's been founded by entrepreneurs. We have maintained an entrepreneurial approach. We like to kick the tires. We like to understand where we can add value, as opposed to spreading ourselves too thin across different jurisdictions. We believe firmly that the Western Cape is the investment case for South Africa, and provincially, we can see across the board investment opportunities, given the fact that the quality of our road infrastructure, electrical infrastructure, renewable energy infrastructure, and bandwidth infrastructure is extremely sound, making the investment case very strong for the entire province. We do also pride ourselves as living in the province that's got the greenest economy. We have been we've been the beneficiary of a very proactive newly appointed mayor that has all the intentions of getting the Western Cape and Cape Town specifically off the load shedding schedule, and we fully support the mayor and any initiatives that he launches to that effect. As a business, we remain extremely client-centric. Our hands-on asset management approach has translated into the financial and operational performance of this business. And just looking forward, our strategic growth objectives are to continue to focus our investment mandate on industrial, both multi-let industrial, logistics, data centers, convenience retail centers, and strategically placed commercial assets. The Western Cape and Cape Town in itself only has so much available land, and that in itself will cause pricing and rental tensions, and we believe that we will be able to take advantage of that opportunity. So just in closing, I think from a business's return perspective, for the calendar year of 2021, Spear provided the market with a 63% total return when you take your capital and your reinvested dividend. We had outperformed the J202, which only returned 60%, but which returned 60%. And we'll continue on our journey to not be the largest landlord in the sector, but we want to be one of the best, and we want to be the landlord of choice within the Western Cape. Our approach, as I mentioned, is people, planet, profit. We believe that those three can operate in unison in a corporate environment. And our hands-on approach to ESG makes us a environmentally, socially aware business with strong governance practices that are in place. And I believe that all of those factors that I've raised throughout this presentation makes Spear a interesting and focused investment opportunity for you to consider. Thank you very much.
Thank you, Quintin. You can now select the breakaway room you would like to join by clicking on the panel at the bottom of your screen.
Okay, maybe just while we wait for people to join. So the way the Q&A is going to work, and I'll repeat this again at the end of the opening sort of comments, is it's going to be based on typing your question in the chat. You can imagine that it'll be insanely difficult to manage this many people's questions if everyone is asking their question, turning on their video, showing us pictures of their dog. So what it is you need to type your message in the chat, and then basically we will moderate that accordingly, try and get through as many of these questions as we can in the time that we have, obviously. If we do run out of questions, then you'll see on the screen there's a slide there with an email address that you can send a message through to. I mean, I think you can ask us on Twitter, for example. You could contact the Keyter Rech team. There's lots of ways to get your question in, and obviously we'll try and deal with as many of those as possible. You are able to switch breakout rooms. So if you have questions for Spear and then you've got questions for Afrimat, you're welcome to head on that side, ask your question, come back, do whatever it is you feel will give you the most value here. And you can switch between them, just using the option at the bottom of your screen. And basically the breakout room is going to end after about 20 minutes. We'll be automatically taken back to the main room, and there we'll just have some closing remarks, and that'll be the end of the inaugural Unlock the Stock. So just in case you didn't get the intros right, so it's Quintin and Christiaan from Spear REIT who are here. They own so many properties in Cape Town that there's even an entire hospital named after Christiaan Barnard, the CFO of Spear. No, I'm just kidding. That's his much more famous namesake, the surgeon. But at the rate you guys are growing, I think you might get there, Christiaan. So if we could ask the attendees to, just send through your questions as you have them, type them in the chat, and we'll pick them up, and then we can ask them as we go. Quintin has threatened to sin if we don't get enough questions, which I can confirm for you is not what you want. It's a bit like James Blunt's threat to put his music back on Spotify if they didn't sort their issues out. So I think let's start really right at the top. I mean, if I think of Spear, if I look on the market, there's lots of REITs out there. Cape Town is your strategic differentiator without a doubt. You're completely Western Cape focused. I think you joked before the call, Quintin, that the furthest you'll go from Cape Town is invest on Robben Island. And this brings some concentration risk, and I'm sure you guys have thought about that. I mean, we saw it happen in the middle of last year, the shocking scenes in KwaZulu-Natal, in Gauteng. There is concentration risk. But if I listen to your presentation and from what I know about your strategy, you see there being a lot of value in being close to your properties. So perhaps you could just talk to, what are the really practical benefits of being close to your properties, but also how do you think about those concentration risks?
Yeah, thank you. I think the benefits most certainly outweigh the negatives of being close to your properties. Having that kind of first mover advantage when you're in a region, you understand not just what your business is about, but you understand what your competitors are doing, is something that very few other landlords necessarily can do with an overly diversified portfolio. And, just to speak anecdotally, we have aspirations to build out a 15 billion rand portfolio, of which, and as an example, Growth Point alone in Cape Town, or the Western Cape, predominantly in Cape Town, owns 27 billion rands worth of real estate. So from that perspective, we're not too worried about is there enough real estate to go around. But as an example, we've found that I can give you a great example with Grindrod Logistics. They rent their shipping office from us. They rent their container terminal from us, which is as a result of our relationship with them from renting their office space with us. They took a 32,000 square meter container terminal on a new 10-year lease. But more than that, because of the primary relationship we had with them, also during COVID, we were able to certify our DoubleTree by Hilton hotel as a repatriation facility. And we were the recipients of all of their cruise ship staff that needed repatriation accommodation, there was no profit in that for us, but we were able to keep people employed. Now, for us to have that type of granular kind of relationship with our tenants, where the CEO of Starrock Shipping, which is part of Grindrod, can phone me up and say, listen, I need accommodation. Can you help? Listen, I need a container terminal. Can you help? I mean, we effectively took 3 different asset types monetized 2 of them for profit and 1 for just for revenue to be able to keep staff employed. And that simply cannot happen when you've got 450 properties across different jurisdictions, and you don't have your finger on the pulse. When there's an RFP out or when there's a major vacancy within our portfolio, generally speaking, those vacancies don't cost us a lot of money, because we know who's moving, who's looking for space, when they're looking for the space, which again, overly diversified there's a strong case for it, but also specialization and knowing your region and being focused has most certainly been a massive value underpin for this business since inception. We're now 10 years plus into this journey, and it's only benefited the business to date.
Yeah, and I guess the benefits outweigh this sort of black swan risk, which, if anyone isn't familiar with that term, it's a very negative and very unusual event. The stuff does happen, and when it happens, it's terrible. And it's hard to run a business on the off chance something like that happens versus the day-to-day benefits that you've highlighted there. I'm going to pick up on Denise's question. I recognize her as a ghost mail reader and a writer for Business Day, so you'll have to be extra careful now, Quintin, with the great answer here, or Christiaan, whoever's going to take it. So her question is, you have aspirations for being a mid-cap stock. And by the way, you guys managed to get out of the Altex, which is a little bit like that scene from Batman where people are trying to escape that very big hole to try and get to main board. And you've done it. There's not a lot of people who have. So well done on that. So you've got aspirations for being a mid-cap stock. What are your sort of timelines for that? I mean, you've talked a bit about growing your portfolio. I mean, how do you get from where you are to that level?
Yeah, I think, hi, Denise. I think it's also, it's less about size and more about growing our earnings. I think that should be the kind of precursor. It's more about quality than quantity. So, since 2016 to date, we've grown the portfolio to just under 5 billion. As we've grown the business, we've also grown in what the market sees as a credible management team. We are now in a fortunate position where large privately owned Western Cape family portfolios are saying, listen, we're looking for a home for our portfolio. We've seen you've got this almost 6-year-long track record, and we only want to remain invested in the Western Cape. Can we look at doing some sort of a vending in? So that's basically where they do an asset for share swap of their portfolio into our company, which could range from 100 million to 1 billion rand. So that is one aspect of growth where we can see us, kind of growing in asset value. And my aspiration, probably within the next 5 to maybe 6 years, we would have achieved that 15 billion. However, just to underscore the fact that 15 billion isn't some sort of goal. It's the journey for us is to grow the assets in quality. It might be 12 billion, it might be 13 billion. I'd rather be able to pay out consistent dividends to our shareholders than just grow for the sake of growing. Because oftentimes when companies have this pressure of just growing, they end up acquiring short-dated accretive assets, where for us as a business, management still owns 30% of the company. So the shareholders take comfort in the fact that when we make an investment on behalf of our shareholders in this company, that if it's good for management, it's good for shareholders, because we are actually also very, very large shareholders within the company. So 5 to 6 years, we think that's possible. We also have about 200,000 square meters of undeveloped but developable bulk within our portfolio, which within the right trading conditions and environment, we can unlock that as organic growth opportunities within our portfolio. As an example, we have a 55,000 square meter development scheme in Pardon Island, which has a total capital value of about 1.5 billion rand, which we are looking to unlock within the next 4 to 5 years, as an example, which would give us great scale in the portfolio. So yeah, hopefully that does give a bit of color. And then acquisitive growth is going to be obviously the main contributor to the growth in the portfolio, with a distinct focus on industrial, convenience retail, as well as data center opportunities, and then commercial assets within very strategic locations with a long dated lease expiry profile.
Yeah, so thanks. That leads me very usefully into the next two questions, which is around the sort of selection criteria you use for the type of real estate you look at. I mean, you've kind of just exited your hospitality portfolio, which I understand is because you're trying to get away from having overly variable income. So there's a question here from Willett around, why have you done that? Maybe you could just confirm that point. And what do you think about when selecting real estate to invest in? And then I just want to touch on Francois' question as well, because it's linked to that, which is, your view on logistics property in the Western Cape, Cape Town infrastructure, the port seems like a good area. E-commerce keeps growing. I mean, I also live down here, so I would echo all of that. Perhaps you could just talk us through some of the thinking around, where you're tilting the portfolio, why you got out of hospitality, and sort of where to from here.
Yeah, so I think the exit out of hospitality, hospitality within the Western Cape, we've had many great years. However, we had 4 really bad years in the sense that we had a visa crisis, we had Ebola, we had day zero, and then we had COVID. And typically as an income fund, shareholders are reliant on consistent income. And with exposure to hospitality, we learned through the process that maybe a large portion of your exposure is to the real estate, but you also have operational exposure, which became operational risk exposure to the actual business operations, because a 20% occupied hotel costs you the same to run as a 100% occupied hotel, given the fact that your fixed costs are what they are. However, if there aren't bums in beds, there's no revenue, leaving you very exposed to the variable nature of the hospitality income. When the tourism market is growing compounded at 8% per annum and your average daily rates are growing, that's fantastic. It's a highly cash generative business, but the income does become very lumpy into the actual business compared to investing into contractual fixed income assets like warehousing, offices, and retail. And over and above that, our cost of tenanting an industrial, commercial, and retail asset is significantly lower than the exposure to an operating business like a hotel. We are exposed to the FF&E in terms of we have to recapitalize the fixtures, the fittings, and equipment. So when you eventually take one step back, we feel that the capital that our shareholders have entrusted to us to steward can be far better deployed outside of the hospitality space. And it's my opinion that hospitality assets are probably far better owned on private balance sheets as opposed to public balance sheets, and fixed income assets, which can give us line of sight as to how we forecast, how we can grow our earnings, is a far better asset to own on a public balance sheet. Anything else you want to add to that, maybe?
Just the risk variable income. It's extremely tough to budget for variable income. We want to show distribution growth, and if we don't know what we're going to earn in the next year, it makes it extremely difficult. And having to chip in more than actually you can get out in the last 2 years, well, made it very difficult. Luckily, we were able to make our budgets and pay our dividends, but it just becomes an unbearable task to try and forecast revenue, because it seems like for almost 4 years, doesn't matter how many times you revise a budget, it just keeps missing it because there were so many factors outside our control, and that makes it extremely difficult. Other than investing into a 10-year lease, we know what you're going to get for the next 10 years.
Yeah, maybe just also jumping into the logistics question. I think the logistics space is an extremely hot space right now. And I think it's only going to get more and more attractive because you've got a mountain on the one side of Cape Town, you've got an ocean on the other. So the availability of land is becoming quite an interesting dilemma, specifically for industrial and logistics focused tenancies. So we're going to start to see mushrooming of additional industrial nodes. As an example, for Santa Crol, the N1 towards Stellenbosch, Brackengate 3, those areas are going to start to develop even further and further. The challenge with trying to extract value on an industrial basis out of, say, Pardon Island, is that the real estate has just become too valuable to function as industrial assets. And that's also why we've embarked already 10 years ago on a site assembly in Pardon Island to develop what we call Marine Place, which is a mixed-use development of approximately 800 residential units, 13,000 square meters of retail, and about 4,000 square meters of of serviced office space because of its proximity to the city. So I think, the ports, yes, obviously you can't move the harbor, but I think from an industrial perspective, the logistics companies have started to see that it's, the placement of their locations, specifically that service the harbor, may have to start happening further and further away, which obviously could impact costs. And we were quite fortunate with our container terminal that we developed for Grindrod, was that the containers that they store there have a specific function for the fruit and grain industry. So the location in Beaconville, Parow, was actually perfect for them.
Fantastic, thank you. And yeah, I mean, we just looked at Hyatt in Magic Markets Premium this week. Leisure travel is kind of back to where it was pre-pandemic. Business travel, less than 50%. Whether or not it's ever going to get higher than that, I'm not sure. So I fully understand that decision to get out of hospitality, especially if you don't want variable income. So we've got about 8 or 7 minutes left. So let's deal with a couple of questions together, and let's give some quick answers and see how many we can get through. So David has asked if converting commercial properties into lettable residential is on your radar. So that's sort of office into apartments, for example. And I think maybe part of that question, Denise has asked what your thoughts are on mixed use development. So I suppose there's a broader question around, is there thinking around anything in the current portfolio that you might be changing, and any sort of thoughts around mixed use going forward?
Yeah, I think it all comes down to, when you look at conversion of offices to residential, you have to, and if you look at even Transcend did a presentation on this, you have to be able to acquire the commercial asset at well under 10,000 Rand a square meter to make it feasible to convert from commercial to residential. And a lot of the properties that have been converted historically have been converted either to semi-hotel and residential, but converted at a time when the market was paying, north of 60,000, 70,000 Rand a square meter for residential. That market has cooled off, but it's starting to pick up again. However, within the city, high-rise conversions have only taken place in instances where the actual acquisition costs on a rate per square meter have been lower than 10,000 Rand a square meter to make it feasible. Given the fact that you need to basically rip out the guts of the property and redo all your plumbing stacks and everything else that is associated with the cost of the conversion to make it a feasible redevelopment opportunity. Just speaking to that. And then on mixed use, we actually really like the mixed use model, and specifically in the Western Cape and in areas like Melrose Arch, it works really well when you can create this mixed use environment of live, work and play, because historically you can trend it backwards that your occupancy rates are generally higher in mixed use schemes. Your rentals are more consistent and they grow consistently in mixed use schemes. And I mean, probably the best example of a mixed use precinct would be the V&A waterfront. Mike, our deputy chairman, in his former iteration, was involved with the development of Wembley Square, which now is home to Amazon and many other residential schemes, the Upper East Side, etc., etc. So mixed use is a great real estate type, and that's also why we are going the mixed use route in Barnard Island, where we can offer proximity to the city at a lower cost to either rent or to acquire with that retail and commercial angle attached to it.
Okay, fantastic. We've got about 4 minutes left. Deborah, if you don't mind, I'm going to leave your question for last because it's kind of an outlook thing. Paolo, your question, are you looking at other acquisition opportunities from listed funds that may be sellers of assets? Is there anything you're seeing that they're trying to get out of that you are thinking of picking up? Obviously, to the extent you can talk about that.
Yeah, we are. I mean, we've got, generally speaking, we've got good relationships with almost all the listed funds. And, if something interesting comes across our desk, or if we think that we see an opportunity to do something either with them or acquire it from them, we'll engage with them. I think there's some good opportunities we're looking at the moment. Nothing set in stone. But I think one of the pitfalls though is that when a specialist fund approaches a generalist fund, they often, second guess why they should be selling it if we're interested in it. So it does become a bit of a tricky navigation sometimes. But we've been, one thing that we've remained consistent in is when we commit to a transaction, we honor every term and condition in that transaction, which then allows those funds for us to do return business. And we've got a great track record in the market when it comes to transacting and to honoring our commitments. And I think that's going to bode very well for us going forward as we grow this business.
Yeah, thank you. We've got 1 minute till the breakout closes. I'm going to quickly point out that you have got a pre-close presentation, which is next Monday, the 28th, unless I'm mistaken, based on the latest SENS announcement. So interested parties should definitely attend that. Go check it out. There'll be another full presentation, more opportunity to speak to the management team here. They are very available to discuss their business. I've seen that myself on Twitter. I've seen you respond to people asking questions, which is great. And you're here today, which also says a lot. I think 20 seconds, Quintin, what is your biggest challenge top of mind in the next 12 to 18 months?
Sure. Our biggest challenge, I guess, would be to, just to, navigate through some of the uncertainties that still exist. I think the return to office, we would like to see the abolition of the Disaster Management Act, because I think that would really, drive the return to work momentum across the board. I think that's one thing. We would like to see government, really just, put more emphasis on job creation, which is a vital thing.
And we have quite a number of people on the call and in this breakout room. So if we don't get to your particular question, I'm apologizing in advance, but any questions that you'd still like to ask, you can email it to Vanessa. Her email address is on the slide here as we speak, or if you want to get on their distribution list for SENS announcements or any other IR communications. I'm just checking now if we have Andries in with us now, and I'm delighted to say we've also been joined by Pieter de Wit, CFO at Afrimat. Sorry, I'm getting confused between our two presenters here quickly. Andries, we haven't got a question from the audience yet. Everyone's a little bit gun shy, but let me kick off with the first one. I've heard you in kind of previous interviews here and there, the diversification strategy is to, try and even out some of the cyclicality within the kind of mining business. And I guess, do you believe that you can actually, get to a non-cyclical mining company with, all the various different assets that you're invested in currently?
Yeah, Mark, if you look at our history, we started off in the quarrying industry. There's probably nothing more cyclical than a quarry in a small town. And if you look at our history, the curve that I showed just now in the presentation of the headline earnings per share that we showed, you can see how well that has been smooth. And now that we are in commodities, if you look, for instance, at the iron ore cycle and the manganese price cycle, for instance, there's a relatively strong negative correlation. So they're out of sync with each other. So long story short, I do believe that these cycles are out of sync with each other and would give us a good edge against the volatility of any single one.
Okay. And could we see another pillar coming into the Afrimat stable? Whether that's precious metals or doing something upstream from one of these pillars or downstream from one of these pillars to kind of enhance that diversification strategy?
Well, we've actually just added a new pillar. We initially in our commodities business. So remember, we started with construction materials. That was a pillar. Then industrial minerals was a pillar. Then in our bulk commodities, we were strongly focused on the ferrous value chain with with iron ore, manganese, and anthracite. And we've recently added what we call future minerals, which is the different rare earths that we can mine, as well as the phosphate, which is around food security. So for now, that's probably where we're going to focus over the short term to make sure that we do execute well. But you know, there are some very interesting opportunities in other spaces as well, which we might pursue in future.
Okay, we've got a couple of questions coming through now. Hi, Andries. With not so much of new mines constructions projects scheduled to come online, how will the Afrimat construction business be sustainable within the next decade?
I think the construction materials business is not really reliant on the mining industry. It's reliant on the construction industry. There's quite a lot of money. You would have heard yesterday that there's more money being allocated to infrastructure. We can start seeing a lot more road projects going to consulting engineers. So the construction sector will keep the construction materials business quite busy. And remember, Afrimat's not a construction company, so we do not have a construction business. We have a construction materials business. We supply aggregates and concrete and things like that to the construction space, and we see that as quite a lucrative market in a year or two from now.
Yeah, it was certainly a key tenet of the budget speech yesterday, plus the changes, the public-private partnerships, and plus the changes for the RA pension guys to actually allocate more capital to infrastructure. The next one is, I think you kind of loosely touched on, how do you expect the electric vehicle revolution to change the demand for minerals, and how is Afrimat positioning for that opportunity?
Yeah, I think the whole drive to electric vehicles, or whether that would be battery-driven electric vehicles or fuel cell, or whatever that is, they all make use of electric motors. And an electric motor needs a magnet, and a magnet, the permanent magnets are made. They need rare earths to be able to manufacture those magnets. And that is the real attraction of Glenova, because it has a very good quality rare earth deposit, which we're quite excited about. That would serve us very, very well in this revolution that's going to happen in vehicle technology.
And maybe one for Pieter. I wanted to get a sense of how you think about debt within the business, capital management. I look at the Australian market a lot, and one of the themes we've seen in this recent last 2 weeks with results coming out is BHP with a massive dividend, Rio with a special dividend. You guys have been consistent dividend payers, as Andries referenced. Just that kind of weighing up acquisitions versus debt versus returning funds to shareholders via dividends. Can you give us a kind of a rough sense of where you're thinking you are in that kind of capital management cycle?
Yeah, I think the first one is the balance sheet and the structure of the balance sheet, and the levels of debt that we're willing to take on. We are quite conservative, so from a board we wouldn't want to overgear the balance sheet. So we looked at not a lot more than 25% debt to equity on the balance sheet. Because of the cyclicality in the business, you want to maintain a strong balance sheet. From a return of your dividends or your cash that you generated to investors, I think the dividend policy that we have currently of 2.75 times cover is something that we will stick to. So we won't pay everything out to the market or to shareholders, because we do see a lot of growth opportunities, and we want to maintain the growth of the company, and the reinvestment of what we're currently earning on our investment in net assets or RONA is over 34%. So we do believe that reinvesting the money in the business and growing the business is better than paying out that to our shareholders.
We have had another bout of it, Andries, in the last 2 to 3 weeks. Load shedding, another key topic, I guess, in the budget and referenced by the last presenter. How does load shedding, I guess, affect you guys at, you know, the mine site, given the, you know, high levels of energy that, you know, these mines need to operate? What are you doing from a, you know, self-generation or redundancy backup set up across, you know, all provinces?
Yeah, that's a good question. We have in all the critical parts of our business, we do self-generate. We have diesel generators in certain places where we need that. We also have special curtailment agreements where that is critical for us. And then the third leg that we have is in most of our operations, we have a bit of spare capacity. So we always make sure that we have, you know, the really important part is not to lose a sale. So we always should make sure that we maintain certain stock levels. Fortunately, we've actually become quite good as a country with load shedding in terms of that has been planned at least. And as long as we know ahead of time when load shedding is going to happen and we can schedule around that, we can do our maintenance at that time, or we can schedule around it. And as long as we are not surprised by it, it doesn't have such a big impact. So the spare capacity, the self-generation, and the good planning, that sort of helps us to get through, and it doesn't really impact the business.
And another one from the audience. You mentioned the entrepreneurial mindset and the great capital allocation of Afrimat historically. How does the Afrimat management team remain so hungry for growth? And, you know, where do you see the business in the next 5 years?
I think it's really a culture thing. You know, it's the type of person that feels enthusiastic about Afrimat is the type of person that gets excited by growth opportunities, about new ventures and things like that. And you know, it's just a part of our DNA, and like-minded people tend to flock together almost, and that is really where we are, and how it's been going like that. And if I look at Afrimat 5 years from now, I think it can be a significantly bigger business, in the sense that if we start looking at when manganese come online, when rare earths come online, when phosphate come online, we look at some of the other exciting opportunities that we see in South Africa, you know, I can see that we can maintain our growth rate that we've been on for the last couple of years. We should be able to maintain that for quite some time still.
And a kind of a colory question, I guess. What strategies are you implementing as you grow and you diversify, you know, that you can retain that kind of core business knowledge of, you know, this is how we do operations. It doesn't matter if we're doing manganese, if we're doing rare earths, if we're doing, you know, stuff on the construction side of the business, you know, the kind of, how do you implement that in so many different commodities, in so many different jurisdictions, that it's not lost as you diversify?
There's a certain core of skills in terms of operational skills that remains the same, and it's almost commodity agnostic. So that's the first step, is to you know, we didn't go from mining to steel making to residential properties. We stick to mining, we stick to operational type of stuff that we are good at, and then on top of that, we actually have broken the business in different clusters. In that cluster, we would make sure that the skill around that specific industry is maintained. So, for instance, the construction materials cluster is run separately from our commodities cluster, because the commodities have a different market, a different way of thinking to the construction materials business, and only at an exco level does all this come together. So it's a bit of a diversified model, I suppose.
Okay. Another question, would you ever consider buying something internationally, even going next door into Botswana, Namibia, or, you know, do you still see plenty of opportunities in South Africa to grow the business?
Well, we've just had to come back out of Mozambique with our tail between our legs. We had a very lucrative business in the far north of Mozambique, and then through the terrorist attacks and the projects being halted there, we had to bring our people back and our equipment. So we're not against doing business in other countries, and especially not in neighboring countries, but it is very risky, and we actually find that South Africa, we've actually developed the skill to do business in South Africa. You know, we've got 43 active mining rights in South Africa, so we have one of the unintended consequences of that is that we have very frequent interaction with the authorities like the DMRE, and that makes us very strong in South Africa. So I guess the short answer is we don't have a strategic reason not to go outside of South Africa, but there's also not a big reason why we want to rush out. If the opportunity is right, the return on investment is right, and the risk profile is fine, we will look at it. But for now, South Africa actually gives us more than enough opportunity.
Another one from the audience. I'm going to paraphrase it. It was actually one of my questions as well. Succession planning, not that we're kicking you out the door, Andries, but they reference Buffett and Berkshire. You've been around the block twice or three times maybe now at this stage. At that exco level, are you focused on building a team that can carry on Afrimat when you want to go and play golf 3 times a week?
Well, on a lighter note, I'm still much younger than Buffett or Munger. But on a more serious note, that is a very, very prominent part of our whole strategy. So the exco, there are probably 2 or 3 people in that exco that can step into my shoes anytime. And unfortunately, I think they'll do a better job, but I won't talk about that too loud. But so we have very active programs for myself, but also more importantly, for those guys that are actually heading up the different business units that are really making the money. Those are the critical people that we need to look after, and that we must make sure that they are good backup for them. And I'm very satisfied that we've got those bases covered. We also spend a lot of time and a lot of money on training and developing of our people, and coaching and mentoring and all sorts of programs to make sure that we have the right people.
Another one, I guess, what keeps you up at night? What are major challenges that could potentially present themselves in the next 12 to 18 months? Is that, I guess, starting up a mine, and it takes way longer to get operational than planned, or a major breakdown of one of your major operations. What are, I guess, some of the risks that can keep you awake at night?
I think the risks, obviously we are operational people, and we are acutely aware of the risks in the business, and I believe we have sufficient measures in place to manage that. The things that would keep me and Pieter awake at night is more the stuff that's outside of our control. Things like cable theft is at the moment a major problem in this country, which is limiting our ability to get our product out of the Northern Cape to ArcelorMittal, and we have to use road transport and things like that. So those are the things that behind the scenes we are working on with the authorities and with Transnet to really address that and get better solutions to that. But I think as a country, we've reached crisis levels of crime, especially on cable theft and things like that. Those are the things that actually threatens the South African economy. And then obviously the bigger international things, the oil price has gone up quite a lot and things like that. We need to keep our eyes on that and make sure that we have strategies in place to do well with that.
A question, another one for Pieter. Can we talk about hedging a bit? Given a lot of your sales are kind of on the world market in US dollars, but your base costs are all in rands here. How do you think about hedging, not hedging the sales side of the business, so that you can kind of be happy that the revenue line isn't going to go berserk from one period to the next?
Yeah, look, the only thing that we are hedging is on the exchange rate a bit. We're taking out some forwards when we know the product is loaded onto the train. That's the only hedging. On the iron ore price, we don't do any hedging. It is an expensive instrument because the forward curve is always downward, and there's a premium involved in that. So we haven't hedged that because you're immediately out of the market. So our hedging strategy is not to hedge, because over the longer term, you will win some, you will lose some. So we decided to ride the market in those fluctuations and rather focus on the cost that we can control, or the things that we can control, which is the cost at the mine, and try to be as lean as possible and keep those costs as low as possible.
And then another one for Andries. Given we had the budget yesterday, a lot of talk about infrastructure on the public sector side. I mean, execution is now the key and what actually comes out of this. But can you give us a sense of, on the construction side, where the industry is at? I mean, green shoots is probably too early to say, but is there a general sense of optimism, whether that's big commercial infrastructure, road infrastructure? Is there a kind of a general sense that things are moving, albeit slowly, in the right direction, and when we get 12, 18, 24 months down the line, that actually a lot of these projects will actually have started?
So there are two areas that excites us. On the one end, we see a lot of road works going to consulting engineers, and out of our experience, we know that from the day the consulting engineers start working until the day we start selling product, that's about 9 to 12 months, and sometimes a little bit longer. But I would say 12 months from now, we should start seeing a lot of road works coming out. For instance, in the Western Cape, the old N1, N2 toll roads projects are now going to be done as a SANROL project, and those projects are with consultants at the moment, and there are a few other exciting big road projects that excites us. And the other aspect that's really exciting at the moment is the renewable energy space. There's a lot of projects on the cards, and we can see that taking off. It's already taking off, and it's going to accelerate into the future. So those are the two areas that excites us.
Okay, I'm just conscious of time. I think we might squeeze in one more before we revert back to the main plenary. What is, I guess, the plan in terms of the ongoing kind of CapEx? What does that look like for a lot of these mines? Is it fairly stable, or should we, as some of these older mines get to rehabilitation stage, should we see like a kick up in CapEx to handle this rehabilitation?
The rehabilitation is something that we make sure that is done as part of the life of mine. So there should not be a kick up at the end. That's a very consistent drive, and there's a provision for that goes throughout the life of mine. So
thank you to everyone that has participated in Unlock the Stock today. And a special thank you to Andries, Quintin, Pieter and Christiaan for making the time in their busy schedules to support this retail investor platform. We hope you have enjoyed this event and that you will join us for the next month's Unlock the Stock event on Tuesday, 17 March 2022 at 12 o'clock, with Tredidor being one of the companies presenting. Goodbye.